Because money is the largest collective delusion known to man. Or more precisely, it's the false belief that the dollar or any government-backed paper constitutes money. Because you see, money must serve three essential roles. It has to be a unit of account. So for example, a gallon of gas is accounted for at a price of $2.34. It's got to function as a medium of exchange, like this picture depicts. And it must be a store of value so that it can retain its purchasing power into the future. On the other hand, currency serves only two of these roles. It is a unit of account and a medium of exchange. By design, the number of units of currencies like the dollar increase with time, so because they are inflationary, they're not really a store of value. Once upon a time, every dollar was backed by gold when we maintained the gold standard. But this was abandoned in 1971. So what is it backed by now? Not much. Which is why the only difference between these two notes is yours, mine, our belief that one has more value than the other. But because most of us still maintain this belief, the distinction between money and currency becomes especially important in the context of the Cantillon effect, which states the first ones to receive the newly created money see their incomes rise, while the last ones to receive the newly created money see their purchasing powers decline. Simply put, those closest to the injection of new money enjoy its benefits at the expense of others. So where is this money created? At the Federal Reserve, who has monopoly power over the creation of currency, though they like to call it money. Quite literally, they have monopoly power. This probably started as a joke, but the central bank never goes bankrupt because it simply prints slips of paper, or these days, electronically creates more currency out of thin air. And when it injects new currency into the economy, it goes first to commercial banks. Next, because of fractional reserve banking and the money multiplier effect, commercial banks can multiply the amount of currency even more and loan it out to other players such as investment banks, hedge funds, and other businesses. Where does this paper currency go after this? Into the stock market, of course. In theory, it's supposed to trickle down, but what happens is the opposite, because currency inflation increases asset prices, thus widening the wealth inequality gap and exposing one hell of an anomaly, as the gains are privatized and the losses are socialized because we, the taxpayers, end up working for this. And as more dollars are printed, its purchasing power goes down relentlessly. So much that a dollar today will buy you only 5 cents worth of value compared to 1913 when the Federal Reserve was created. Which means the weaker the dollar due to inflation, the less it can buy and the more expensive asset prices become. So when the Fed used taxpayer money to bail out the very perpetrators of this crisis because they were deemed too big to fail, it pissed a lot of people off, understandably so. Careless mistakes were made and the people were taken advantage of. Because this was a stealthy wealth transfer from the poor to the rich, leading to income and wealth inequality such that the top 20% hoard nearly 90% of the wealth in the USA, leaving us wondering, what happened to the middle class?